Investment flash.
The Fed just told you the soft landing isn't coming, and bond market carnage is hitting new extremes. TLT at 52-week lows, oil spiking. This pain trade is just getting started. We're breaking it all down right now.
Good morning. It's Thursday, July 30th, New York edition. I'm Marie, here with Gerald and Tom.
Tom, your US oil fund buy call from yesterday up another 3% last session, buddy. Almost feels like you planned the Iran disruption.
I wish I had that kind of power. No, but seriously, the supply story just got scarier. The FT says US oil inventories are precariously low.
Right, and it's not just the FT. Nikkei Asia is reporting widening trade deficits across Asia because of these prices. That's demand destruction that hasn't hit yet, so the floor is real.
Exactly. So our inferred signals here are buy US oil fund and buy oil services ETF. USO is up about 87% year to date, but still 16% below its 52-week high.
Yeah, look, crowded trade, mate. USO is almost double its 52-week low. The easy money's been made. Chasing it here is pure momentum.
Hold on, Gerald. The inventory crisis is real. Low stockpiles, Iran disrupting supply. That's a supply shock, not just momentum.
The WSJ says Exxon and Chevron's Venezuela negotiations have stalled. That's a production growth headwind. And negotiations stalling is the new "we're exploring strategic alternatives." Just corporate speak for "we tried nothing and we're all out of ideas."
Haha, fair enough.
Oh, that's brutal.
But yeah, the inferred sells on Exxon and Chevron make sense. Chevron up 23% year to date. And without Venezuela, near-term production growth is capped.
But both are still double digits below their highs, and the oil price tailwind is massive. Shorting them is brave. You'd need a catalyst beyond stalled talks.
All right, let's talk Fed. The vote was 9-3, with 3 members dissenting to hike. Most hawkish dissent in this cycle.
And long-duration treasuries are right at their 52-week low. Selling them is the treat. Momentum is firmly bearish, and the Fed just poured gasoline on it.
Tom, that's the 3rd time this month you've said sell long bonds. The trade is packed. Short squeeze risk is real. One dovish comment and it rips.
I know. I sound like a broken record with the long-duration bear case. Next thing you'll tell me is I should short long bonds. Oh, wait.
All right.
Okay,
but did you see the S&P 500 ETF? Down 1.54% last session. That's not just bonds, Gerald. The hawkish Fed is removing the equity put.
See, this is what I mean. The most original take of the day from Nikkei Asia says the AI boom might bring short-term inflation with little GDP gain. If that's right, the Fed's hands are tied. No cuts, maybe more hikes.
Right, yeah, the AI concentration story is now in bonds. FT says credit is as dominated by AI as equities, so we've got concentrated risk everywhere.
That's why we're also selling investment-grade bonds, the LQD ETF, near its 52-week low. If the AI thesis wobbles and inflation rises, spreads could widen.
No, but that's exactly my point. The AI boom could be inflationary, not deflationary. That challenges the whole AI will save us narrative. The market repricing that risks everything.
Totally.
100%.
That's the whole story.
All right, but let's find some green. Nikkei also had a survey showing Chinese firms growing global market share in 40% of products. That's structural improvement.
I'm going to push back here. Chinese corporates gaining market share isn't new, but tariff risks are still there. Still, the China Large Cap ETF, FXI, is down 9% year to date and only 16% above its low. Could be value.
Honestly, the China A-shares ETF, KBA, is only 7% below its 52-week high. That's the real rotation. If the competitive upswing continues, it's a buy.
Exactly, buddy. Both China Large Cap and A-shares on our buy list. KBA up 5.8% year to date. Room to run.
And here's another bright spot.
Brookfield and Nextera are building a $100 billion data center campus in Kentucky. WSJ exclusive. Massive AI infrastructure bet.
100 billion. No way. That's a multi-year demand driver for renewables. Buy Brookfield Renewable, BEP, and NextEra, NEE. BEP is 17% below its high.
It's early stage, long dated, but I'll give you this, it's a concrete catalyst. NextEra up only 9% year to date, not fully priced.
Fair enough. Federally backed, private capital. This isn't pie in the sky.
Right, so on to the pain. FT Lex says reality bites for South Korea's memory chip wonder stocks, and regulators are curbing leveraged ETFs after the Kospi fell by a third.
EWI still up 41% year to date, but down 17% in a week. The unwind is accelerating. Sell South Korea equities, no question.
Hold on. The Kospi crash is a warning signal. If emerging market stress spills into credit, that's the catalyst to turn cautious sentiment into something uglier.
Yesterday we had buy Samsung Electronics. That call is underwater, with EY down 17% in a week. My timing, impeccable as always.
Oh, come on.
To be fair, the whole sector is bleeding.
Exactly. And the dollar isn't even mentioned much today. Our view flagged it. With a hawkish Fed and oil surging, EM currencies must be under heavy pressure.
All right, then critical minerals. FT says hedge funds are raising bets against US-backed miners. The Rare Earth Strategic Metals ETF, REMX, down 15.9% year to date.
Pain is well underway, but may not be over. Shorts are piling on, momentum against them. MP Materials, MP, down over 30% and near its low.
Hedge funds raising bets against US-backed miners. Because nothing says policy tailwind like being short a sector that depends on Washington.
Yeah.
That's fair.
Last one, Ford. MarketWatch says its big truck bet is paying off, up 8% in a week, 14.5% year to date, but trades at 8.1 times forward PE.
That's a valuation disconnect. If the turnaround holds, there's upside. Buy Ford, ticker F.
All right. 8 times earnings, I can stomach that. Value in autos. Who'd have thought?
So, our view, old certainties are cracking. Fed isn't dovish, oil inventories low, AI concentration in bonds, long duration treasuries at 52-week low, S&P wobbling.
But the counter-argument is crowding. Long bonds at low, investment-grade bonds hugging zero. Bearish bond trades are packed. A short squeeze is possible. Chasing lopsided positioning is risky.
Right. And the dollar's absence is the wild card. If EM stress blows up, it could domino through credit. So we're cautious, but these signals are worth respecting.
Respect the pain.
Exactly.
Spot on.
As always, none of this is investment advice. We're just connecting the dots.
And if you're just finding us, hit follow on Spotify or check investmentflash.com for the full digest with charts and sources.
We're back tomorrow at 7:30 a.m. London time for the London edition. See you then.